Hi everybody, my name's Griffin Bridgers. This is part 14 of the basics of generation skipping transfer tax. Today we're going to dig into valuation and timing, and also dig into some other subtopics that are related to that, things like qualified severances and retroactive allocations and late allocations of GST tax exemption. Now, before we get started, as always, I want to remind you that this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So to recap so far, one big common theme in this series has been timing. So what do I mean by timing? Well, the core theme we've covered so far is that really you have two separate events. One is allocation of GST exemption, and one is the potential allocation of a deferred generation skipping transfer. These are often separated, so the question is, when do we take into account the value of property that's subject to the generation skipping transfer? What really depends on the purpose. Is it at the time we're allocating GST exemption, or is it at the time when a later generation skipping transfer might be occurring? So today is all about reconciling those outcomes. Now I'm going to assume that you kind of know the general valuation rules for gift and estate tax purposes, because we're usually going to derive those values where the gift or estate tax correlates to either the exemption allocation or an actual GST tax. So the only time you really have actual GST tax correlating to estate or gift tax liability is in the case of a direct skip. Now, just to kind of give you the overview, our general rule will typically be the fair market value on the date of a generation skipping transfer or on the date of an indirect skip. So that's really derived from the gift or estate tax rule that takes the fair market value of the property at the time of either a completed gift tax transfer or the decedent's death. Alternatively, if you can use the alternate valuation date for an estate tax value, that might apply as well. Any of those perfectly tie right into this anytime estate and gift tax accompanies the GST tax reporting event. Now, in the case of a direct skip, the GST tax value, both for allocating exemption or determining the GST tax liability, because you do either or both on the event of a direct skip, but that value will be the same as the value for estate or gift taxes that are reportable at the time. But there are some adjustments which have been peppered in through this entire course, which I'm going to call out here. One, if there's any estate tax liability, then there's usually tax apportionment that can spread that tax liability out amongst the different beneficiaries and different gifts and shares. So the value of a generation skipping transfer for exemption or GST tax purposes is first reduced by its share of any estate tax liability, which is a whole other subject, and we'll touch on 706 reporting, where we'll get back into that subject towards the end of this course. Another point is that the value of a generation skipping transfer is also reduced by any gift or estate tax charitable deduction. And then finally, I want to remind you of this rule we looked at early on that says that the gift tax value of a direct skip is increased by any generation skipping transfer tax actually paid on the transfer. But keep in mind, that doesn't change the underlying value of the asset. It simply increases the gift tax liability by the GST tax liability. So when you have two taxes like that in rapid succession, one affects the other, with GST tax coming first for gift tax purposes. Now, when we get into an indirect skip, all we're really concerned with here is allocating GST exemption. We're not worried about any gift or estate tax or really a GST tax, because typically you're never going to have GST tax paid at the time of an indirect skip. There might be a gift or estate tax at the time, and we have those same adjustments that we just looked at earlier, with the caveat that since no gift tax is paid, payment of GST tax is not going to increase the gift tax here. But our general rule will be that the gift or estate tax value will be the amount of GST exemption you allocate, subject to adjustment for things like GST tax annual exclusions and even some excludable gifts that we briefly touched on earlier. But again, you want to remember that when it comes to allocation of the GST tax in the case of an indirect skip, which again we'll look at on 706 reporting, you'll need to net out the estate tax and any estate tax charitable deductions before allocating GST exemption. So what if no gift tax return is filed? That's always the big question, or even if no estate tax return is filed. You can make a late GST exemption allocation, but that's where a later conundrum kicks in that we will look at, which depends on whether the return is timely or not and whether you relied on automatic allocation. But what does an indirect skip lead to? It leads to one of two events, either a taxable termination or a taxable distribution. So in the case of a taxable termination, our value rule is going to be different. We're going to, this is the timing issue. We're now separated from a gift or estate tax event, and we now have to reappraise the property because the fair market value of the property subject to the taxable termination will be the GST tax value at the time that the taxable termination occurs. So in other words, you have to redetermine fair market value on the date of the taxable termination. You can't use an old gift or estate tax value typically. Now, you would keep in mind that gift or estate tax, again, usually won't accompany a taxable termination, so you don't have to worry about those adjustments. But again, you don't have a corresponding gift or estate tax appraisal that you could rely on. Now, one catch here is that sometimes you might have a gift or estate tax appraisal that's required in this case. You can have something that looks like a taxable termination on its face, but is really just a shift of transferor. The difference being in that case, the old inclusion ratio is wiped out and you create a new one based on the new transferor's allocation of GST exemption. So what's the difference? Really, the question here is whether the taxable termination apparent comes about as the result of any event where there's a gift by the new transferor or inclusion in the gross estate of the new transferor, which is usually a non-skip beneficiary whose death or termination of interest is bringing about the potential taxable termination in this case. So in that case, if the transferor doesn't shift, you have a taxable termination. You have to get the fair market value of the property at the time for that taxable termination. If the transferor does shift, then really you have the equivalent of a brand new direct or indirect skip, which is subject to the prior rules, now with respect to the new transferor instead of the old transferor. Now with a taxable distribution, again, we look at timing. The fair market value of the property that's actually distributed will be the GST tax value. So again, you have to reappraise the value of the property being distributed in kind. Now, typically this is going to apply to cash, so you don't even have to worry about value. Really, what we're worried about here is if you have an in-kind distribution for GST tax purposes. So again, like we saw with the taxable termination, gift or estate tax usually will not accompany a taxable distribution, so you don't have to worry about those adjustments for any underlying gift or estate tax liability to determine the true amount for tax purposes of the taxable distribution. But what you do have to worry about is this little lurking issue in a lot of tax spheres called a circular calculation. When there's a taxable distribution, the skip person who's receiving it is responsible for paying the GST tax, not the trustee, but the skip person recipient. So what happens here is if the trustee does actually pay the GST tax in conjunction with the distribution, what that will do will increase the amount of the taxable distribution by that GST tax paid, which in turn increases the amount of the taxable distribution itself, which then in turn increases the amount of the GST tax that's owed. So if the trustee keeps paying it, it leads to this circular calculation, which really has no end until you reach some kind of finite limit based on a curve like you might have seen in calculus if you ever took that. So circular calculations are bad, and they usually pop up when somebody else pays tax that you're obligated and liable to pay. So you want to avoid that outcome with a taxable distribution here. It's a better idea, perhaps, maybe, for the trustee to simply increase the distribution amount by the amount of the potential GST tax so that the beneficiary, the skip person beneficiary, has enough there to pay the GST tax and net it out to the true intended distribution amount. Now, you might also want to keep in mind that we looked at this earlier, that taxable distributions can also be subject to income tax. If the taxable distribution carries out distributable net income or even capital gains, perhaps through a cash distribution or maybe an in-kind distribution where there's a 643E election to treat that as if the trust sold the property for fair market value, then the skip person has an income tax liability and a GST tax liability on that distributed property. But in this case, again, matching up the taxes, there is an income tax deduction you can take for the GST tax paid on the distribution. Now, we looked at the end of an estate tax inclusion period, or ETIP, too, and how that can create issues. And I briefly alluded to this fact earlier, but the core issue is that when an ETIP ends, the fair market value of the property at the close of the ETIP will be the GST tax value. So what's the significance here? Well, you could have a direct skip, a variety of different transfers at the end of an ETIP. In either case, you're looking at the fair market value of the property at the close of the ETIP. And where this really rears its ugly head is in the allocation of GST exemption. Keep in mind with an ETIP, you cannot apply or allocate GST exemption at the time of the transfer. Instead, there's automatic allocation at the close of the ETIP if you don't actually elect out of automatic allocation. So what this means is that it's a good idea to elect out of automatic allocation for ETIPs, because usually the value at the time of the transfer will be much less than the value at the close of the ETIP. So if you want to avoid this large value at the end of the ETIP, especially with something like a zeroed out GRAT being subject to GST exemption automatic allocation, you need to elect out preferentially on the first 706 or 709. And if you don't do that, it's not too late, but what that means is that you're going to have to be intentional about filing the right return in the year that the ETIP ends in order to elect out of automatic allocation of GST exemption at the time. Otherwise, you run the risk of using GST exemption for the entire now larger fair market value, which may not get the benefit of discounts, the benefit of, or prior growth that's been removed from the taxable estate, and even the benefit of time value of money, the discounting for things like a GRAT. Now, there's something called a qualified severance, which we haven't talked about yet, and it's more of an intermediate and advanced topic, but I'll briefly introduce it because it has a valuation component, which we're not going to get into. It just helps to know the rule. But what is a qualified severance first and foremost? Well, if you have a trust that is not fully exempt or non-exempt, in other words, if a trust has an inclusion ratio between 0 and 1, because not enough GST exemption was allocated to make it fully exempt, what you can do is sever it into 2 shares if the trust document allows that type of division or if state law allows that type of division. So one share will have an inclusion ratio of 0, which will be the exempt share. The other share will have an inclusion ratio of 1, which will be the non-exempt share. So the formula for doing this is heavily value-based because it relies on the fair market value of the trust at the time of the severance to determine how much goes into the non-exempt share. I may do a separate part on this, or I may look at more of an intermediate and advanced type of course as a follow-up to this, but for the time being, that's a good rule to remember, is that a qualified severance is based on the fair market value of the trust at the time of the severance to determine the amount of the non-exempt share. And you must file Form 706 GS parenthetical T with a self-authored notice of qualified severance attached in the case of this type of severance. Now, what if you never get around to filing the appropriate return to allocate GST exemption? Is all lost? Not necessarily. Automatic allocation is designed to cover you in this situation, and it can save you if there's a failure to file gift tax returns. But if you run into the situation where both A, no gift tax return is filed for a transfer, and B, you had a prior election out of automatic allocation for the trust in question, then you can do a late allocation of GST exemption to the trust, but with a cost. What is that cost? Well, in this case, you have to use the fair market value of the property at the time of the late allocation. So if you have elected out of automatic allocation and you've relied on manual, you have to be consistent with your gift tax returns for every transfer, because if you're late on one, you're going to have to revalue the property as of the date of the allocation on the late return. And there can be some late election relief, but that's a complicated subject for another time that we won't get into here. You can read a number of private letter rulings that have dealt with late allocations or late elections out of automatic allocation if you go to the IRS written determinations website. But long story short, the only time you have to worry about this value rule is if you're not relying on automatic allocation. If you do have a transfer for which there is a late gift tax return, and you haven't previously on a prior return elected out of automatic allocation, then you can file a late gift tax return here. Now, you could have a penalty on the late gift tax if there is one, but in terms of GST exemption, you can just reflect what was automatically allocated at the time of the original indirect skip or indirect skip transfer that's subject to the late return. Now, there's one neat trick called retroactive allocation that we're going to look at separately, which really looks at a trust where the transferor has not allocated enough GST exemption or any to it, maybe because a non-skip beneficiary is anticipated to outlive the transferor and allocate their own GST exemption to it. But if a non-skip beneficiary who has either a current or future interest who's in a lower generation predeceases the transferor, then the transferor can go back and allocate the transferor's own GST exemption retroactively. And how do they do that? They do it by filing a gift tax return for the year of the non-skip beneficiary's death, which then goes back and chronologically, in order of time of when the contribution was made, allocates GST exemption to each prior transfer. But the neat trick here is, in this case, you can use the old values on the dates of the transfers for the GST exemption allocation. So this only applies in the case where a non-skip person predeceases the transferor, but this is something to keep in mind that a lot of people don't know about and can be a neat trick in an otherwise sad situation. So, I know there was a fire hose of info today here, so I'd encourage you to listen to this a number of times because I've distilled valuation principles that are peppered all throughout the chapter of the tax code dealing with the generation skipping transfer tax. So I've done my best to distill those. There may be a couple things I missed, but we're getting close to the end here. What's coming up in this series? Well, we have Gallo trusts coming up, special considerations for ILETs. We'll cover charitable lead trusts and how to allocate GST exemption and calculate the amount allocated. And then we'll dive into case studies for the 706 and 709, a very detailed one with the 709 breaking down by popular transfers in an example format. So, in terms of our glossary of terms that we've learned, just for your review and checking off the boxes, we've added two today. We have qualified severance and retroactive allocation. So you can add that to your arsenal of GST tax terms and principles to know about. But I thank you for listening to today's presentation. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. But I thank you again for listening, and I look forward to seeing you in my future content.